Very good evening to you all. So in today's session, what we will look at is the outlook for Sri Lanka for the next couple of months, and also our view in terms of how the economy will pan out for 2024. Right? I'll start with the most important and interesting part of the macro story, which is on the interest rates. And in terms of the interest rates, our view right now is that Sri Lanka and the Central Bank of Sri Lanka is looking at easing monetary policy further, and it has the required reasons why Central Bank has to look at reducing policy rates in the next couple of months. For the main reason being, we are seeing inflation, which was one of the main concerns that kept the central bank increasing interest rates, where our policy rates went north of 28%, is now starting to come down. And inflation is now down to 4%. We'll see inflation numbers falling to about 2% by the end of the year. And this is a lot stemming from the base effect. But the good thing is that the incremental increase that we saw in terms of product prices have now stalled. So even though we haven't seen a major reduction in terms of prices, the escalation that we are seeing in prices have kind of come to a halt. So overall for the year, by the end of the year, we are looking at somewhere close to 1.5 to 2% by the end of the year in terms of inflation. It's entirely stemming from the base effect. And with inflation being low, the other main thing is that the economic growth is not up to trajectory, right? So if you look at the left side chart here, the left side chart shows the dark blue line shows what Sri Lanka's GDP growth trajectory would have been if there was no crisis. Right? But because of the crisis, our sustainable GDP growth has now adjusted downwards, which is what is depicted through the pink line. Right? But where we are is what is depicted through the light blue line. Right? So if you look at the light blue line, we are way lower than what the new, even below the new sustainable GDP growth rate. Right? Which means that Sri Lanka has a negative output gap, and the central bank has to push Sri Lanka towards or needs to give the required stimulus through monetary policy to kind of get us back to the sustainable growth rate, right? So the gap is huge. So we've plotted the numbers in terms of output gap. So Sri Lanka has a negative output gap, and the output gap is quite negative right now, which means that it needs a lot of stimulus in terms of monetary policy to kind of get the growth kicking in. The good thing with inflation is that the demand-driven side of inflation has come to a halt. And one of the main reasons behind this is that the amount of money printing that we did, excessive, we printed about, Sri Lanka printed about 2.7 trillion rupees of monetary printing over the last 1.5 years. That is now starting to reduce. So if you look at the left-hand side chart, it shows the incremental money printing that took place every month. And if you look at the last few months, you're seeing that number. They are basically reducing their position in terms of the central bank holdings, right? So with no printing and the central bank entirely depending on market financing to finance its fiscal deficit, we are not going to see that demand-driven inflation, where we saw the impact of the central bank putting enough and more money in the hands of people, and that converting into inflation where it went up to 70% levels is not going to be there, because now it's being curtailed in terms of the amount that the central bank is printing. And the other positive news is that from a market liquidity perspective, market liquidity is turning positive, right? So there was a huge shortage in terms of market liquidity in the last 6 months. And with more dollars coming in, the balance of payment turning positive, the central bank is buying those dollars through reserves and pumping rupee liquidity to the system, right? So the rupee availability in the market has improved and will improve further with the expected improvement in the balance of payment, and also the expected financial flows that we will talk about in our external sector, which will also mean that more dollars coming in can be converted into reserves, and the central bank can infuse more money to the system, right? So better availability of credit will also help in terms of the interest rates being lower in the next 3 to 4 months, right? So from a policy rate perspective, we are expecting policy rates to reduce by about 200 basis points, and that will happen faster. So we expect policy rates to even start falling from the next meeting. So there's 2 more meetings pending for the year, one in October, I believe. And from that cycle onwards, we feel that the rate cuts will be initiated. And this will have a trickle-down impact on the secondary market rates as well. So the treasury bill rates, which are currently holding high because of the delays in terms of domestic debt restructure and the government increasingly financing their deficit through treasury bills instead of long-term bonds, that composition will also happen where once the domestic debt restructure is concluded, you will see the government raising a lot more money through bonds than bills at the moment, right? So, which will also reduce the pressure in terms of interest rates on the short end. Right? So, from our view, we expect the 12-month treasury bill to fall to about 10 to 12%, and the average weighted prime lending rate will fall to about 12 to 13.5% by the end of the year. Right? And the reasons behind it, and the main reason behind it is the risk premium attached to the domestic debt restructuring, right? So this has been the main hold on in terms of why rates have not been coming down. And with the conclusion of it, you will see more participation coming into even the bond market. Over the last 2 auctions, we haven't seen the pension funds participating in the bond auctions. There have been large auctions. Last auction was about 200 billion, but we haven't seen participation from the pension funds. But now, after the conclusion of the domestic debt restructure, the pension funds can start coming in and buying bonds from the auctions. Right? This will mean that with the reduction in terms of the risk, you will see the treasury bond rates also falling off a cliff. Right? So even during the last 3-4 weeks, we saw a sudden spike in terms of interest rates because there was suddenly a bond auction and the pension funds were not there to subscribe. Right? So this phenomenon will reverse very soon, and the conclusion of the domestic debt restructure will be done within the next 2-3 weeks. Right? And for sure, by the end of September, we'll see this happening, which will result in a faster reduction in terms of interest rates. So going into the 4th quarter, we are going to see a steep reduction in terms of interest rates. Right? So from an interest rate perspective, Sri Lanka is looking at a more accommodative stance. Then comes the story in terms of what is our growth trajectory going to be? Where is Sri Lanka heading towards? By the end of the year, we are expecting GDP growth to be between -1.5% to -2%. And a lot of it is to do with the base effect that will kick in the last 2 quarters of this year. But large part of the growth trajectory, the recovery cycle, will actually start coming in next year. Right? And traditionally, we've seen monetary policy taking easily about 6 to 9 months to reflect in terms of the credit cycle and that converting in terms of GDP growth, right? So most of the growth will start kicking in from next year, and we have other factors which will also support the growth trajectory. So as you know, credit has started to pick up. Overall, credit growth has turned positive month on month. Still small amounts, which is why you don't realize it too much. But if you look at the appetite for demand, the demand for credit, we are seeing companies now starting to relook at their borrowing requirement. Working capital requirement is increasing. So everyone's starting to plan for 6 months down the line, planning to increase capacity, because keep in mind, last 2-3 years, most of the companies haven't increased capacity. They need to do refurbishments. They need to increase their capacity of their businesses. So they're kind of gearing up for them starting from now. So next 6 months, you will see this credit cycle also starting to happen, and that converting into GDP growth with businesses starting to pick up. And traditionally historically we've seen private sector credit growth and GDP having a very strong correlation. So as long as there's a stable and moderate credit growth, we will see that converting into GDP growth, but with the assumption that there's no other turmoil or any other issues that kind of disrupt economic activity. The demand for credit is also reflected in the surveys done by the central bank, where now both the willingness to lend by the financial institution after the conclusion of the domestic debt restructure because now banks and financial institutions also understand that their gearing positions are better, their tier 1 capitals are better. So the attitude and the willingness to lend from the financial institutions has also started to turn positive now, right? So they're willing to lend. And from the consumer side of things, you're also seeing demand, and this is a survey done by the central bank where you're seeing now indication for credit has turned positive from the credit survey conducted by the central bank. And the companies that we're engaging with, all of them are indicating that now they are planning for next year, going into a better year for 2024, and which means that you need to start looking at expanding, right? And also sorting out issues in terms of working capital. The working capital requirement is increasing, so that's going to drive credit demand for 2024 and even the last quarter of 2023. Already you're seeing this starting to reflect in terms of your economic indicators. The PMI, the Purchasing Manager Index, has started, is up 12% for the year. Obviously, the transportation activities increased. It's reflecting in the auto fuel sales. Electricity consumption, even though prices shot up by 60-70%, consumption of electricity is back on track. It's moving up to where it was. I think from the peak, we're only down about 10% from where we were in 2021. Overall import-export activity, the cargo operations have also improved. So overall, we are seeing an improvement or the indicators are now indicating that economic growth is also starting to is in the initial phases of recovery. Right? One of the largest contributors that could make a material change to GDP would be tourism. Right? And tourism used to account for roughly about 4 to 5% of GDP. Right? And that contribution fell down to about 1.6% last year. But if you look at the numbers for the second half of this year, we were averaging about 100,000 tourists during the first 6 months. We are going into about 150,000 plus in the second half of this year. Right? So there's a 50% increment in terms of the tourism numbers coming in, and which will mean that the tourism component alone, because that's growing by a significant amount, that can have a material impact, or roughly about, for the year, just the impact for the second half of this year from tourism will be about 2.4%. So the growth increment that you can see from tourism will be about, or addition to growth, will be about 2.4%. So it will be a material contributor given the size of we're talking about eventually tourism coming to about $5 billion in terms of revenue, and that being roughly about 7% of our GDP in the coming years. The only sector we feel that might be slightly slower in terms of picking up would be construction. And construction historically has been a large component of our GDP and has been primarily driven by the government, right? And government infrastructure activity has been the preliminary driver of construction. And even on the private sector side, you're not seeing retail construction picking as fast as expected. It's the last thing that people have in mind, right? So people are still sorting out their basic needs. They're getting back on track in terms of what they were consuming before. Still a long way to go in terms of retail constructions to pick up, right? And if you look at, from a government's perspective, the government is cutting down on capex. So if you look at the tax numbers, which we will show in the later slides, tax numbers are not coming through as expected. So the only way that the government is still meeting their fiscal targets is by cutting down on the capital expenditure, right? So for the year, Sri Lanka was planning for about 1.1 trillion of capital expenditure. We will only close at about 500 billion rupees of capital expenditure. So that cut will reflect in terms of the construction activity. So overall, we are expecting GDP growth to start kicking in. Next year, reaching 3% is not a big ask, to be honest. We can actually do more than 3% if tourism maintains the current trajectory, and also if consumption starts picking in. Keep in mind, with the handouts given with the World Bank program, you'll see the low ends of the population also getting a bit of money, and that kind of stimulating into economic activity and having ripple effects across the system. Tourism is not only about the direct contribution, but also the indirect contribution it has on the overall economy. So that will also trickle down in terms of economic activity, right? So the accommodative monetary stance, the recovery in terms of tourism, right? And also the conclusion of the domestic debt exchange and more foreign activity coming in We'll see a little bit of foreign FDIs also starting to come in. A few projects will also start happening once the DDR is concluded. At the moment, countries like Japan can't do anything at the moment until the external debt restructuring is completed. So once even the external debt restructuring is concluded, we'll also see more money coming into the FDI side of things as well. From an exchange rate perspective, we don't expect a major depreciation of the currency till the end of the year. We are expecting the currency to hold stable at 320 to 330. And there's a couple of reasons why. One of the significant slowdowns that we saw was on the remittance side. The remittances have now started picking back up. We are on average raising about $470 million a month in terms of remittances. Very soon it will be about $500 million in terms of remittances. The component of people were not sure of the stability of the country. So you're seeing now people coming back in terms of looking at investment side of things in Sri Lanka as well. Right? One component which completely was kept away was people were just sending money for their families to survive. But now we are seeing the investment component of their contribution in terms of remittances also coming back into the system again. And as you all know, that there has been a huge a migration spree which resulted roughly about 500,000 to 600,000 people leaving over the last 1.5 years. So that component will also start contributing in terms of adding to the remittance flows in 2024. So if you look at the work remittances numbers, first half was about $2.8 billion. Second half, you're looking at about roughly $3.2 billion. That's an additional $400 million coming in. Roughly, you're looking at about roughly about $60 to $70 million incremental work remittances coming every month compared to the first half of this year. And obviously, the larger component would be the impact coming from tourism. Tourism numbers are kicking in or getting close to the 2018 numbers, which was the peak year for Sri Lanka. By the end of the year, we are expecting tourist numbers, arrival numbers to cross 200,000 mark. This month, we did 42,000 for August. It's going to be easy hit in terms of crossing 200,000 by the end of the year. So going into the winter season, we'll see tourist arrivals crossing 200,000 per month. And what it means is that your earnings from tourism, which was only about $1 billion for the first half of this year, will be about 50% higher in the second half of this year, which is roughly about $1.6 billion coming in from tourism. Right? So major increase in terms of tourism earnings that you will see in the second half of this year, and especially towards the latter part of the quarter. Right? Because remittances and tourism is making incremental moves in terms of the current account, it doesn't matter whether import controls are allowed or not, right? So even when the import controls are allowed or taken off, the incremental increase in imports is not material enough to make a big difference in terms of covering up for the reduction in terms of current account, because work remittances and tourism are more than compensating for this component. And even when import controls are relaxed, we are yet to see a major spike, and that's because of the purchasing power of the local consumer has not recovered to what it was. So from our perspective, we are looking at about, for the second half of this year, roughly about $50 to $100 million of import increase happening, or import bill increasing by $50 to $100 million a month. But your incremental increase on tourism and work remittances is more than that component. Right? So because of that, you're not going to see any major impact on the current account as such. The other good thing is that obviously the import prices have been holding low, so your import bill automatically has been holding low. From an overall perspective, balance of payment is positive right now, and a lot to do with the delays in terms of foreign debt payments, but also the reduction in terms of the trade deficit has also helped us a lot in terms of keeping the balance of payment positive. So if you look at the first half of this year, we've recorded roughly about $2 billion of BOP surplus. And second half, we're looking at roughly about $1.3 billion coming into the balance of payment surplus. Right? So it's a reduction because first half there was not much imports and so on. but second half it kind of reduces, but still positive and enough to kind of build our reserve position to the IMF target. So IMF target is $4.4 billion of reserve by the end of the year. And we are currently at about $3.7 to $3.8 billion, which means that we only need about $700 million of incremental reserve buildup, right? But our increase that we are going to see in the BOP is about $1.3 billion, which means that we will be able to even make payments on a little bit more on the ACU settlements, pay a little bit of the, or complete the Bangladesh swap settlement, and a little bit of trade credit that we took during the year can also be settled given the current equation running right now, right? So at the moment, currency doesn't seem to be too much of an issue, but going into 2024, obviously the debt repayments will start coming in, which will mean that roughly about $200 million a month of incremental payments will start every month. Plus, when vehicle imports are allowed, you'll see a sudden surge. It's going to come with higher taxes, the prices are going to be higher, but obviously it will add to about at least $100 million in terms of incremental addition to our import bill. Plus, obviously when you're expecting economic growth and economic recovery, it comes with imports, right? So next year will be challenging compared to this year in terms of the currency, but it's not going to be major. You're looking at about 5 to 7% in terms of a depreciation of the currency for next year. The other good news is that from a financial inflow perspective, in terms of the multilateral and bilateral funding which is pending, Sri Lanka has about $900 million of financial inflows that they can then materialize, and that's stemming from the IMF component coming in of $330 million, coupled with the World Bank and ADB components of about another $300 million. We have $900 million of financial inflows yet to come if we complete the external debt restructure, right? So this also kind of gives you that cushion in terms of the currency, right? And a lot of it can be converted into rupees. The World Bank component is coming for the handout program for the low-income families. So it will be converted into rupees. So all this will mean that you can kind of see the currency not depreciating too much, and us being able to settle some of these loan payments, especially on the trade creditor funds that we've taken during the last 24 months. The problem area from our perspective, obviously interest rates look good, growth is getting back on track. It's low, but it's getting back on track. Exchange rate is stable, at least for the end of the year. But the problem area we feel is the fiscal side of things. In terms of our targets, Sri Lanka's tax revenue collections have not been as much as expected. Obviously, second half will be greater than the first half because of the activity pickup. But still, we are not going to meet the numbers that the IMF is looking at in terms of the targets in terms of taxes. So how Sri Lanka has managed still to maintain the primary deficit and budget deficit targets is by cutting down on capex, right? And that's not something great going into it affects your growth over the long run. So the government will be forced to kind of look at capex to a certain extent in the coming years, right? Which means that the only way that we can manage the fiscal deficit and the primary deficit is to look at more tax increases and obviously collections, right? So collections have not been too great, particularly on certain areas. VAT has been good, the advance, on salaries, those taxes have been good, but where we've been falling short is on income tax collections as well as the import duties. So those two areas, they will have to scrutinize more. Collections, they'll be pushing for more. But obviously, the economic recovery will also kind of help with vehicles used to be a large component to tax collections. All that will also start kicking in. But the government will look at incremental tax additions. We feel it will be more tilted towards collections rather than increasing the tax rates as such. Why we say the fiscal part is very important is that if we don't maintain the fiscal trajectory that is required by the IMF, we won't see our debt numbers coming down, right? So all these numbers, the debt restructuring works on us working on getting our debt to or deficit to GDP down to what is required by the IMF. Right? The right-hand chart shows that, for example, if we keep running at this 8% deficit, which we will close at this year at, if we keep running at those deficit levels, we will be at that pink line on the right-hand side, which means that our debt to GDP stabilizes at about 110%, but it doesn't come down to that 80% that we require, right? So, which is why the fiscal part of it is very important, right? So, tax collections has to be relooked at by the government. In terms of expenditure, there's limited areas for the government to actually reduce, right? Because large component is interest now, salaries have to be paid. The only component, volatile component, is the capex part of it, but the government can't keep reducing their capex for the foreseeable future. So they have to kind of kickstart some part of the capex program next year, which means that a lot of focus will be going into taxation and tax collections. And if you look at the jump that is required, so for 2023 on the primary deficit, the 0.7% is manageable because we're cutting down on capex, but the jumps that are required for the next couple of years is huge, right? And that means that you have to make major changes in terms of taxation and collections, and also obviously the economic growth will also kind of make a play in terms of making a big difference on the tax collection. So tax is one area that the government will have to look at seriously, and which can have a material impact to the overall fiscal consolidation program of Sri Lanka, right? So as long as we do not derail from the current trajectory, and we need to improve on collections, ensure that there is no impediment to economic growth, we can hit these numbers, right? So it's a matter of, and normally what happens is that the first year that you do your fiscal adjustments, you don't see revenue coming up. The actual increase in terms of revenue comes in the subsequent years. T+1 and T+2 is when you really see the numbers starting to kick in. So as long as the political and there's no other impediment in terms of growth, automatically we should see this trajectory improving, but obviously from a collection perspective, there's much more that the government will have to kind of focus on. So as I mentioned, collections is an important issue. Our import taxes as a percentage of total tax is very small, and if you compare import duty collections as a percentage of an import bill, that is also very small compared to what you see in the region. So one is, from an import perspective, collections need to be improved, plus things like vehicles where your duties are 300-400% will also add a material change on the import duty numbers coming in. And with the relaxation of import, all the items taken out of the imports, we'll see that also gradually coming back, but from a duty perspective, the component coming from customs is not sufficient. From an excise perspective, now the increase in terms of taxes, what they've done on cigarettes and alcohol is turning out to be counterproductive, because now you're seeing the inelastic demand kind of leading to lower revenue collections from an excise duty perspective. So in a growth phase, the government should not look at taxing more, or at least reduce in terms of the taxation, because it has come to a point where the low income, the population is not going to be keeping on increasing their consumption on alcohol and tobacco when tax rates are going up, right? So that's one area. The performance has been below expectations from a government's perspective as well. And obviously other component is your income tax collections. The government is looking at digitalization and so on. Next year, they will look at going into 2025, wealth taxes has been proposed by the IMF. The IMF is looking at roughly about 400 billion rupees collected per annum through wealth taxes. It can be in the form of a 1%, 2% on your entire wealth, or they can just look at the financial sector and impose something like a higher WHT or taxation on your financial income. So these are ways and means that the IMF will be also looking at pushing Sri Lanka towards hitting our fiscal targets. So compared to our previous 17 programs, this program, the IMF is more stringent. They are more strict in terms of how they are looking at numbers and ensuring that we don't fall apart in terms of our fiscal numbers. But this is one area that will, as investors, we'll have to keep an eye on, because if we fall short in terms of tax numbers and if you're not hitting these fiscal numbers, which will mean that the government will also have to make material changes, which will obviously impact capital markets as well. So in terms of takeaways, obviously, from an interest rate perspective, interest rates should start falling faster, and that will happen by the end of the month when domestic debt restructuring is concluded. And we expect a reduction in terms of policy rate to start happening from the month of October. And the ripple effects in terms of your AWPLR and bond market rates coming down will also happen faster than expected. From a growth perspective, growth is gradually picking up, but next year is where you'll see material numbers coming in, and from a business environment, things will start looking better. From a price perspective, inflation is going to still remain low. We are not going to see any kind of demand-driven inflation because our growth is still below potential. So that will also ensure that inflation doesn't kick in when growth kind of kicks in. From an exchange rate perspective, we are expecting stable currency until the end of the year. But next year, when we have debt payments coming and so on, there will be a 5 to 7% depreciation of currency, which is manageable from a perspective of looking at Sri Lanka's past. From a fiscal perspective, that will be the challenge. Government will have to put a lot of focus in terms of improving collections. But also on the other side, reducing interest rates makes a material impact from a government's fiscal perspective because the interest cost is a large component. So faster the government can bring the interest rates down, that has a material impact on the fiscal position of the country as well. That's a summary in terms of what we are looking at the economy.